Welcome to my channel. I'm Scott, and in this video, I am going to walk you through the process of valuing Serco Group stock by analyzing their financial statements and dissecting their financial ratios so we can determine if it's a buy or a sell. Serco Group is a government contractor for health, transportation, justice, immigration, defense, and citizen services. It also works with some institutions as well. It provides its services in the UK and throughout Europe, also North America, Asia, and the Middle East. In the first half of this year, 52% of its revenue was from Europe. That's equivalent to £1.2 billion. 22% of its revenue is from North America, 20% Asia, and 6% Middle East. In the defense sector, it provides engineering, nuclear, space, and maritime services. In the justice sector, it provides custodial services, immigration detention services, and monitoring and transporting detainees. In the transport sector, it provides rail and ferry operations, road traffic management, and air traffic control. In the health sector, it provides facilities management, support services, and patient administration. In the citizen services sector, it provides case management, middle, back office, and IT services, and employment and skills services. The company is headquartered in the UK and was founded in 1929. It started trading in '88 and can be found on the London Stock Exchange, BATS, Pink Sheets, and Deutsche Börse. We'll look at the ticker that trades on the London Stock Exchange, so all the numbers in this video are in British pounds. Let's get started with the model. This is a small cap company, £1.7 billion. They're trading at 136 pence, or £1.36, and they have 1.2 billion shares outstanding. Let's look at their financials. The way you value a company is you estimate the free cash flows into the future, and then you discount those numbers back to today's value. That's what we're doing in this video. And free cash flow is cash flow from operations minus capital expenditures. So they did have negative free cash flow in 2018, but it was positive and growing after that. Net income is the profit or loss on the income statement. It's revenue minus expenses, and that grows a lot from 67 million up to nearly 300 million pounds. Revenue is a sales for the company, and that also grows really nicely from 2.8 billion to 4.2 billion. This is the company's income statement. The top line is the revenue, the sales. Here's a breakdown of their revenue by sector and location. 32% of their revenue is in defense, 30% in citizen services, 17% in justice and immigration, 12% in transport, and 9% in health. Half their revenue comes from Europe, 1/4 from North America, 17% from Asia Pacific, and 8% in the Middle East. They're not only focused in the UK, it seems like they're focused all around the world. So there's a lot of opportunity for them to grow their revenue. Below revenue is the cost of revenue. These are the expenses directly related to generating the revenue. Revenue minus cost of revenue gives you your gross profit, and that peaked at 440 million. Then below that is operating expenses. So their main operating expense is selling, general, and administrative expenses. This is mainly payroll. Also, the rent for their corporate office will be in this field. And they do generate positive operating income each year. It more than doubled from 2018 to the trailing 12 months. That's what I like to focus on, operating income, when I look at the income statement. Because if a company can't generate positive operating income, there is a problem. In the early years, it's fine if you have negative operating income. But if you're a mature company and you consistently have negative operating income, that's a real big red flag. They have a decent amount of debt on their balance sheet, so they pay 25 million of interest on their debt. And the bottom line of the income statement is their net income, which is positive every year. And the reason it was so high in the trailing 12 months, not because they had the highest revenue and highest operating income, it was also because of this 118 million tax credit. It probably seems odd that a company generated 180 million pounds of profit and still got a tax credit of 118 million pounds. The taxes showed on the income statement aren't the taxes the company actually pays. This is more of an accounting item, because the company had to report a deferred tax asset which was due to historical losses from the group in past years. If the company records a different tax amount than the government calculated, the company has to carry a deferred tax asset or deferred tax liability on their balance sheet. So you could probably just ignore it. But if you wanted to understand it more, just Google deferred tax asset and deferred tax liability. This is the company's statement of cash flows. The top line is operating cash flow. That's how much cash the company generates from its operational business. You could think of operating cash flow as net income converted to cash, because net income is your accounting profit or loss. It's not actual cash. So they do generate a lot of operating cash flow, and it's been growing each year. It was only 2.7 million in 2018. Now it's 337 million in the trailing 12 months. They also spend a good amount in CapEx. CapEx is investments in property, plant, and equipment. Operating cash flow minus CapEx gives you your free cash flow. And that's how much cash is remaining for you, the investor, so the company can buy back stock or pay a dividend or reinvest back into the company to grow it and make it bigger. It looks like the company issued 139 million of capital stock in 2019. When a company adds capital stock, that dilutes the current shareholders, so it makes your shares less valuable. The two main reasons a company would issue capital stock is to fund their day-to-day operations or to acquire another company. It is possible they could be using it to pay a dividend or to buy back stock as well. It looks like the most likely situation is they acquired another company since they had positive free cash flow in 2019 and they didn't pay down any debt. And it doesn't appear they bought back stock and they weren't paying a dividend at this point. This is the equity section of their balance sheet. They have 916 million pounds of equity. They raised 463 million from issuing stock, and they profited 483 million from running their business. Retained earnings is a sum of all your net incomes minus the sum of all the dividends you paid out. Let's look at the capital structure. 916 million of equity, 838 million of debt. They're 52% equity, 48% debt. Their weighted average cost of capital, which is a blend of the cost of equity and cost of debt, is 8.09%. And that's the discount rate we're going to apply to the future cash flows. We estimated 4 years of future free cash flows. We also estimated terminal value, which is all cash flows past year 4, that's 4.1 billion. We discounted those numbers back to today's new weighted average cost of capital. We get a value of the company of 3.8 billion pounds. We divide that by 1.2 billion shares. And we get a calculated stock price of 308 pence. They're trading at 136 pence. So they're trading at a 56% discount. It's a buy according to the model. The average analyst forecast is for their revenue to grow only 0.6%. The way I calculated their future revenues is I grew it 0.6% a year until 2024. And the way I calculated their future free cash flows, I first needed to figure out what percentage of their revenue they convert to free cash flow. So I took the sum of these three free cash flow numbers, 79 million up to 293 million. I took the sum of those three numbers divided by the sum of these three revenue numbers, 3.2 billion up to 4.2 billion. I excluded 2018 because they had negative free cash flow. So it appears they convert 5% of their revenue into free cash flow. So I multiplied my future revenue estimates by 5%, and that's how I got these future free cash flow numbers. And all these numbers are below their trailing 12-month free cash flow. So I do think it's a conservative estimate, and I'm still coming out with a stock price a lot higher than they're trading at. Simply, Wall Street values the company at 199 pence. So they're saying it's 32% undervalued. This is where the stock has been trading since 1988. So there was this big run up right here, then it came crashing down, and then another big run up that took a few years, and then it came crashing down again. And it's been pretty steady since this point, since the beginning of 2015. So the reason the stock came crashing down in 2014 was because the company overcharged the Ministry of Justice on a contract to tag offenders. So when people come out of jail, they need to keep an electronic device on them so they don't go too far out of a certain territory. And this company sold those devices to the Ministry of Justice, but overcharged them. The government has really deep pockets, so I think they get overcharged all the time. This company must have went overboard for them to get sued. So Serco had to repay the government 68.5 million pounds. And there was a poll done, and 63% of people said Serco should be banned from bidding on any public contract. Obviously, they're still bidding on contracts because they'd be out of business if they couldn't. So there's been a black cloud over this company since 2014, and that's why the stock is really undervalued. A lot of people just won't buy the company stock anymore. The company pays an annual dividend. They pay 1.4 pence, and their dividend yield is a little over 1%. They stopped paying a dividend from 2015 to 2019 because they were losing money because they lost a lot of business from the government after overcharging them. Things are getting much better for this company. Their revenue is up a lot and they're profitable. They have a really low beta, 0.32, so the stock doesn't move too much. It moves about 1/3 the market. It's gone down 2% in the past 52 weeks. The 52-week low was 106 pence. The high was 148 pence. And the stock is trading pretty close to its 200-day moving average, but below its 50-day moving average. About 3 to 3.5 million shares are traded each day on this stock. Almost all the shares outstanding are on float, and 68% are held by institutions. The stock is down the past year. Its industry is up and the market's up. The stock has done well the past 3 years, beating out its industry and the market. But in the past 5 years, it's only up 4%, its industry 57%, and the market 39%. Analysts are bearish on this stock, projecting their earnings to decrease 30%, their revenue to increase less than 1%. This company is doing really well. In the past 5 years, their annual earnings are up 66%, and in the past year, it's up 144%, mainly due to that large tax credit. If you put $10,000 into this company in 2012, you'd be crying, losing almost 80% of your investment. The biggest shareholder owns 12% of the stock, then BlackRock, Fidelity, Marathon Asset, and RWC. Let's look at their financial ratios. They have an amazing PE ratio of 5.6. So their numbers are improving dramatically the past few years, but their market cap is not improving. People are just not buying this stock. It's severely undervalued, at least according to their ratios. They have a great price to sales of 0.4. They also have a good price to book at 1.8. They do have a lot of intangible assets on their balance sheet, nearly 1 billion pounds of intangibles. So their tangible book value is negative. They have a really high return on invested capital, 11.1%. They have a good interest coverage ratio, a solid ROE. Their current ratio and quick ratio are a little below 1. They have 193 million pounds of cash on their balance sheet. And even though they have negative working capital and they pay a small dividend payment, it seems like they're bringing in a lot of free cash flow, enough to cover those amounts. The best way to look at ratios is to compare them to companies in the same industry. I've done videos of 6 other companies in the same industry as Serco, and if Serco has a number in red, they're worse than the average. If they have a number in blue, they're better than the average. So they have amazing price multiples, much better than average. They have a low current ratio, really good ROE. They're higher than average in debt. And when I converted all the market caps to pounds, they're much smaller than the average company. They did start paying a dividend again, so their dividend is a little higher than average. So to summarize, I have them trading at a 56% discount, but just because something is trading at a discount doesn't mean people are willing to pay for it. I think there's a black cloud hanging over this company. It seems like investors are still annoyed that this company tried to scam the government. They did change management more than once, so they're trying to get away from that image. But I only think it's a matter of time until people realize how well this company is doing and how undervalued it is. But let me know in the comments what you think about this company, what you think about their future. I ranked their free cash flow 7 out of 10, their revenue 8 out of 10, and their ratio is 10 out of 10. So let me know what you think. Give this video a like, subscribe, or comment below. Also, if you'd like to get a custom valuation or just support the channel, you can become a member by clicking on the link in the description below. Thanks for watching.